Okay. Hi everyone, welcome back to another OctaFX webinar. We have an educational session tonight. A lot to cover. So if you do have any questions, do type it in the chat. I'll go through it at the end of the session during the Q&A session. Audio seems to be good on my side. If there's any issue, do type it in and let us know. Okay, so tonight it's going to be momentum and volatility in the market. There's going to be a lot to cover. I'm not sure if we have enough time to cover stochastics, but we'll go through in depth in Rsi and Macd. I use stochastics every week, so you can jump in on the Wednesday session if you do have any questions, just in case if we didn't have enough time to cover that. Okay, there's a lot to take in, so get your notes ready, get your tea and coffee out when we're gonna get started. Okay, all right, so it's momentum and volatility in the market. My name is Vito and Henjoto, and we can kick it off with a quick general advice and risk warning disclaimer. Note that any advice given is deemed to be of general nature, as the information or advice given does not take into account your particular objectives, financial situations, or needs. Therefore, at all times you should consider the appropriateness of the advice before you act further. CFDs and Forex are leveraged products, thus carry a high level of risk and are not suitable for everyone. You can lose more than your initial deposit, so you should ensure CFD and Forex trading meets your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. Okay, so just a little bit of a housekeeping here. It's going to be an educational session tonight, so don't ask me questions about the market. That's not what we're going to cover tonight, live market. So we're not going to take a look at the market tonight. We are going to focus more on learning. Okay, so this is the agenda for tonight. We are going to go through the definition of momentum in trading. I want you guys to understand what momentum is. How do you apply it in a trending market? We're going to step a little bit into momentum investing, and then we're going to take a look at momentum application in a sideways market condition. Then most important part is definitely how to actually read the overbought and oversold market condition. And I can guarantee you, those that haven't gone through this with me, probably about 80 or 90% of you might get the overbought and oversold condition wrong. So we're going to straighten that out tonight. We're going to talk a little bit about divergence, but we're not going to go in depth into divergence because there's going to be a separate webinar for divergence. Now we're going to take a look at Rsi and Macd. I'm going to leave stochastics at the end just in case we don't have time for that, because stochastics is going to be a little bit more practical. I'm just going to show it to you straight on the chart. So hopefully we do have time for stochastics. Otherwise, we're going to touch briefly on stochastics, but I want to go down deeper with Macd and Rsi tonight. Okay, I'm great. How's everyone? I hope you guys are doing great as well. Deposit bonus, Team Octa might be able to answer that for this session. Okay. We'll still be conducting the Wednesday night English webinar with weekly Friday session. I think we are going to keep the I know we talk about Wednesday being an educational session, but I think the plan is to keep the Wednesday session as a live market session, and then Friday we are going to cover educational stuff. Okay, so with that, let's kick it off. Let's take a look at what definition of momentum is in trading, because the topic is momentum and volatility, so they are actually two separate things. Momentum in trading is actually the speed of change in the price of an instrument or an asset. Okay, so we're talking about velocity here. So something that I don't think a lot of people actually use the term velocity. People talk about volatility and then mix it up with momentum. Momentum is not volatility. Momentum is actually velocity, or the speed of change in price. So momentum measures the change or rate of increase in price within a set period of time, and that's basically what your indicators are going to be. Changes in momentum cannot be used to measure the potential magnitude of price movement, so there's actually no correlation between how far the oscillator goes up and how it relates to price. They're completely two different things. Momentum measures the change in price, so price could be moving rapidly, but maybe in small increments, and it will, tell the oscillator to actually print out a very high momentum in the market, but it doesn't actually reflect, how big a movement is actually going to be. Okay, in the stock or equity market, momentum is more useful in an uptrend because a downtrend in the equity market has a correction limit for every move to the downside. We can jump in later on to give you a quick glimpse of what the US 30 is. But if you know your equity market well, you do know that it continuously posts a new high, even after the global financial crisis in 2007, 2000 to 2009. All right, so those dark moments there where people thought the market was crashing. Look at where the US 30 and S&P 500 is right now. It's probably nearly double that or close to tripling that actually. Okay, in CFDs, especially future markets, including Forex, all right, Forex is part of the Forex that you guys trade with OctaFX is actually part of the CFD market. It's actually the futures market. Momentum is useful for both uptrend and downtrend, and the reason is pretty simple. You can quickly buy and sell in CFDs, right? You don't actually do that as conveniently in the equity or the stock market. It's slightly different there. Short selling, I think if you come from a stock trading background, it's not in your mindset to actually short sell, but we'll talk more about that later on. Okay, because momentum is also associated with trend movements, the use of momentum in correction or sideways or consolidation or range bounds market conditions is going to be used in a different way. That's why I prepared two potential use case scenario. Obviously, we want to focus more on the trending side, but there's actually it gets a little bit tricky with sideways market condition, and some indicators works better with sideways market condition. We are going to take a look at that tonight. Okay, so pretty simple definition of momentum in trading. I just want to remind you guys, momentum is not volatility. Volatility is a completely different concept. Momentum is actually the velocity of price changes in the market. Okay, so yeah, if you guys are new here, this is actually going to be really, really useful. Stochastics or RSI sometimes won't work, and the momentum will continue to the direction where it's trying to go, even if we put time frame or 4-hour time frame. I'll guarantee you after this session, you are going to figure something out, okay? But yes, your statement is correct, and that's why we need to look at the overbought and oversold condition, because that's the problem with people using Stochastics, RSI, and Macd. They just get overbought and oversold condition wrong, and obviously if you get it wrong, that's basically your account down the drain. Okay, so we are going to go through that, and I can guarantee you by the end of the session that's going to be something new that you can take away from this, and hopefully that would be a better understanding of an overbought oversold condition, because I think that's really key when it comes to using oscillator as your indicators. Okay, let's move on. Okay, let's take a look at making sense of what momentum is in the market. I like to use this analogy. So we have a car, right? Just don't read the slides. Just listen to what I'm saying. Okay, just don't go ahead and read the slides because it's not gonna work that way. When we start our car and we want to go somewhere, obviously you need to press the gas, step on the gas, the pedal, right? And then accelerate. But you'll notice that when you accelerate, the initial acceleration is actually going to be slow, right? Unless, obviously, if you're driving a fancy sports car, that's going to be different. But we're talking about a general standard car, any type of car. Initial acceleration is actually going to be slow. Now, when the car that is already on the move, you can actually control it with the brakes or the acceleration pedal, right? You can put more gas into it, you can speed up, or you can actually slow down. And this is what the oscillator is going to be doing. This is how the momentum is going to function, right? It's not going to go one direction non-stop. And you might have to take a break sometimes when you drive, right? I mean, if there's a car in front of you, you're going to step on that brake, but you're still going ahead. You're not really slowing down. There's actually still speed in that movement, and that's basically what the momentum is. So we're talking about velocity, we're talking about speed here, okay? Okay, so basically when you get your car running, you lift off the gas pedal, it's actually gonna cruise, okay? It will continue to run without input from the pedal, maintaining a little bit of a speed compared to the car not running. And it will actually be a little bit easier for you to accelerate faster when it's already on the move. There's no initial startup. There's not going to be a little bit of a lag there. So you can actually step on the gas and it will just go a little bit faster. Okay, so you don't actually have to wait for momentum to build up, as in the case of initial acceleration. So when you step on that brake, what happened to the car? The car will actually decelerate, and this deceleration will last until the car stops, okay? And the cycle starts again when the light turns green. Let's say you stop at the red light and when the light turns green, you step on that gas, you go again, you start with initial acceleration. So let's take a look at the translation to the market. So your initial car acceleration, that's actually coming out of overbought oversold condition, or if there's actually a pattern breakouts or a hidden divergence. Okay, we're talking about a potential continuation here. When the car's actually on the go, we are looking at a normal trending market. The car and the market goes in one direction. The market starts trending or starts to go in one direction. When we talk about trend, again, let me just rephrase this for you guys that ask about trends. If you take a look at the trend in 15 minutes, it's not going to be the same trend as it is in a 4-hourly time frame. Trends are actually time frame dependent. Okay, hopefully you guys clear this off. That's number one on the list. Just make sure, because I think there's a little bit of an misunderstanding in terms of above 70 and below 30 for the RSI, above or below the zero line or on the MACD. Okay, what I'm trying to say here is this. If you use stochastics, right, or like one guy that asked this question just now, we put stochastics, it goes one way and it just follows the trend, doesn't stop. You know what happens here? Because if it is in an uptrend, stochastic goes above 80, the trend could actually speed up. It's actually not an overbought condition, and this is where a lot of people got it wrong. Okay, the trend could actually accelerate to the upside if it stays above 80. Okay, likewise, if you're using RSI, 70 is not the overbought level. It's not the way we look at an overbought or oversold condition. In fact, if the RSI goes above 70 and the market is trending really strongly, it could actually stay above 70 or above 80 if you're using stochastics and stays there for a period of time. And that's actually where the trend doubles up. Okay, you're actually, if you go to your chart, okay, take a look at where the stochastics or RSI goes above 80. That's where the trend actually speeds up. Okay, if it's an uptrend, it'll just really speed up. If it's in a downtrend, take a look at the Euro USD, for example. It stays below 20, the trend actually speeds up to the downside. Okay. So number 4, when you step on that brake, okay, the car will decelerate. That's when we talk about overbought and oversold condition in the market. We'll take a look at that in the overbought and oversold condition section, but just make sure that there's actually a difference there between the oscillator hitting the threshold limits. That's not an overbought oversold condition. There's a different criteria for it to actually be overbought and oversold. For those that have attended my previous session, you understand this and you know this very, very well. Okay. So when you start this deceleration. When the deceleration of the car starts, that's basically your consolidation period or sideways period or range bound market condition. Okay, like in the Euro USD, we had that downtrend, and then, oh, trust me, I know this very well. The market starts going into a range bound market condition from the 18th of July until last night. Basically, for 1 month, it stays in a sideways market condition. It stops from being in a downtrend. It actually becomes a range bound market condition for a month. Take a look at that from the daily the daily chart, and you'll understand it immediately. You want me to give you the dates? It's actually 18th of July until last night, exactly 1 month. Okay. So when the light turns green, trend starts again, and the whole thing just kicks off again. Okay, so hopefully this explains a little bit about what we're looking for tonight. We're not looking at volatility, we're not looking at other stuff, we're looking at what momentum is. Okay, so how do you apply this in a trending market? So in a general use of momentum will actually fall into this category, because if we learn from the equity market and we take away momentum and then apply it into the market, most of the time, or basically about 80% of how an oscillator works is actually designed for the equity market, and that's why it's actually designed for a trending market. Okay, so when we apply momentum into a trending market, that's how we're going to take a look at it. Momentum is much better. It's easier to understand when it's actually applied to a trending market. So don't think about, a counter trading a market. We want to focus on, trend is your friend, follow the trend. That's the kind of stuff that we want to take a look at for this section. Okay, so if you're new, I know a lot of people are new here. This is highly recommended for beginners if you want to explore the mechanics of a momentum. Okay, so obviously you need to have some understanding of what a trend is. We'll cover that in a little bit later on in the next chart. We're actually going to take a look at that. So basically we are using the underlying trend of an asset to determine the market direction. Okay, momentum doesn't work if you don't understand what a trend is. So if you're here and you don't understand what a trend is, we're gonna cover that in a Q&A session. But stay here, stay with me. If you want to look more into understanding what a trend is, you can do that after the session. But make sure you understand what an overbought oversold is. Something that's really key. Okay. So when you apply momentum into a trending market, it's actually really easy, because you only acknowledge momentum with a direction that matches the underlying trend. So you need to understand if market is actually if a market is in an uptrend, you basically just want to apply momentum that follows an uptrend. So we're not looking for a sell in the market, we are continuously looking for a buy in the market. That's the kind of momentum application that you want to be looking for. Okay, so we're gonna call this type 1 momentum, basically a trending market. It's actually going to be clearly visible and very easy to identify if there's an underlying trend that can be confirmed. Okay, for an easier application, use trend identifiers such as, I use Ichimoku Kinko Hill and I use Ichimoku Cloud to identify a trend. But I'll give you a quick tip later on. You can actually use 2 moving averages, but not like a normal use case scenario where you actually have a fast and a slow moving averages. We're actually going to be using two very similar moving averages to actually identify the trend. Okay, but you can actually use moving averages. You can use Ichimoku Cloud, or you can use traditional higher high, lower high. Higher high, lower low for an uptrend, and lower high, lower low for higher high, higher low for an uptrend, lower high, lower low for a downtrend. So high high, high low, right? That's an uptrend. Low low, low low, low low, low high, right? That's for a downtrend. So just remember that. Okay, just a quick note before we go on to the next slide. The observations of using momentum in the trading market are based on momentum investing. Some of you probably heard of what momentum investing. This is actually what the equity market uses. Okay, when there's actually a bullish market condition. So we know the logic. We buy low, we sell high. It doesn't apply in a bullish market, and that's probably why there was that question there. Oh, we apply stochastics, it's not going to work because the trend is so strong. Because that's not what we're looking for. We're not going to be looking for buying low and selling high logic. The logic is out of the window. This observation is actually more on buying higher and selling higher. Okay, it's not buying low, sell high. It's actually buy high, sell higher. That's the kind of logic here. It might be new to you guys, but if you guys are from the equity market background, you'll understand this really well, what momentum investing is. Okay, we're gonna talk a little bit more about alpha and beta as well, so you guys understand what it is when people talk about seeking alphas. That's basically what trading is. Okay. So as I said before, because Forex has a different market model from the equity market, the theory can actually be applied to an uptrend or a downtrend market as long as the market is trending. Okay, that's the main difference between an equity market and the FX market. Okay, the currency market doesn't care if the market goes up or down. It could be in an uptrend or a downtrend, but you talk to a stock trader, and you ask them, hey, it's a bearish market, you know, a lot of them are going to be stressed out because to them short selling is actually going to be a little bit of a weird thing to do. Okay, so this is basically what I'm talking about when we talk about an uptrend. Obviously you guys can see clearly what an uptrend is, but take a look at where the blue arrow is. That's basically why I use the Ichimoku cloud, right? If price is actually above Ichimoku cloud, we consider that as the start of an uptrend. Okay, so taking a look at that, notice the stochastics. When it breaks to the upside or when it transitions above the Ichimoku cloud and becomes a trending market, the stochastic is actually above 80. Let me see if I can get my pointer out. So take a look at this. Okay, market goes up above the Ichimoku cloud. That's basically the start of the uptrend. You take a look at the stochastics. It's actually above 80. Okay, a lot of beginner traders or even experienced traders still get this wrong. That is not an overbought condition if it stays above 80. In fact, when it goes above 80, it kind of speeds up, right? It doesn't slow down until it actually drops back down below 80. Take a look at where it actually pauses for a little bit of a consolidation. Notice this. Stochastics only move a little bit here, but price goes up like 100 pips. Okay. Now, take a look at where stochastics drop down below 80 in an uptrend. The market only goes down 67 pips. And this is where, if you think momentum goes up, price is going to shoot up high. That's the wrong kind of logic, because logically, if you think stochastics drops down, the market needs to drop down a lot. It doesn't have to, because it's in an uptrend. And we're talking about speed of change. We're not talking about how far a drop or a run to the upside is going to be. Okay, so hopefully this clears it up a little bit. And then take a look at this chart very closely. I actually put up this blue vertical lines. That's basically where the transition of being an oversold is. Okay, if we kind of figure out, okay, the market is going to be in an uptrend, we don't want to sell the market. Okay, because if you take a look at the run here, stochastic goes above, it drops down below 20. That's not really an oversold. It only becomes oversold when the stochastics actually drop down below 20 and then goes back up above 20. And that's where the blue line is. And that's basically when the markets start moving again. So we got a 67 pips of a little bit of a consolidation range. Stochastics crosses up again. It's pretty flat down here. It's quite irrelevant if you take a look at this one. Market is just, maybe there's a car in front of it. Market just takes a little bit of a break there. But follow me here. Notice the second blue line here. Okay, that's kind of the upper end of the range because the market starts going above 80. We need to be a little bit more cautious there because the moment it drops below 80, that's when it's going to start correcting again. So in an uptrend, if you only look for a crossover from the downside to the upside on the stochastics, okay, or the RSI starts ticking up, or the MACD give you a bullish crossover signal, doesn't matter what you use. But if you know what the trend is, right, and you only take a buy when a momentum shift, that's a clue. That's why people say, you know, trend is your friend. Don't go against the trend, because if you go against the trend, that's where it messes you up. Okay, obviously if you don't have a good understanding of trend, that's completely okay, because this is going to give you a stepping stone for that when after this session and you want to figure something out about what trend is. But that's why, you know, experienced traders just keep telling you that. It's not really cliche. I know it sounds cliche, but it's actually a fact in the market. You know, how do I maintain consistency in the market? Is I just don't go against a trend. Simple as that. If you jump in on my Wednesday session, I just stay clear of a potential reversal or whatever until I have a clear confirmation of anything. Okay. In fact, on Wednesday, I actually replied on the video. Go to that video on Wednesday. I actually replied a comment there saying that, oh yeah, I lost both trades, blah blah blah. Read that comments. I actually put a link in that YouTube comments. You guys can probably understand it if you understand what I'm talking about. That there's actually no trades triggered because market is in a sideways market condition, so it's illogical for that, you know, someone to actually lose out if you follow that video on Wednesday. But hey, I mean, if you're curious, you didn't watch Wednesday video, you're missing out. Seriously, go watch that video. A little bit of a self-promotion here. Anyway, going back to the topic here, you can screenshot this chart if you want, but you can always go back to this video if you want. But take a look at the stochastics here. When it crosses from down there, and when it crosses up, right, when the fast stochastics crosses above the slow stochastics, that's where the market is going to continue to trend. And if you know the underlying trend is to the upside, you only take an uptrend. You only take a buy trade. Simple as that. Reverse this. If the market is in a downtrend, obviously you're going to be looking at, you know, just stochastics crossing from above to below. Simple as that. But you don't want to go against the trend. If you're looking at momentum in a trending market, yeah, you got momentum. Right? The momentum indicator is there so that you don't take the wrong trade. As simple as that. Okay, it's just logical. If you want to go against a trade, then why bother with momentum? Because you're just going to go there and just risk it all. It's completely up to you, right? But hey, anyway, we start with stochastics above 80 level, and that's where the uptrend starts. If you take a look at the end of the chart, it breaks a new low, and take a look at the stochastics. It's actually staying there below 20, and that's actually where it transitioned to become a downtrend. Okay, so this is on the pound USD. There's the date there. I'm not gonna lie. There's actually a date there. It's I started identifying this trend starting from the 22nd of July. It ends at the end of July. This is on the hourly time frame, by the way. So it ends around 30th of July 2021. That's when this was taken. So yeah, if you want to go there and check it out, feel free to. Okay, so momentum in the trending market, always go with where the underlying trend is. Do not go against the trend. Simple as that. When you want to go against the trend, make sure that you want to go against the trend, make sure the market is actually in a sideways market condition without identifiable trend, and that's where you can actually apply momentum up and down. That's completely fine. You're trading within the range. But if it's trending, it starts trending, you need to figure it out. Okay, don't use it wrong. That's basically the message here. Very simple. Okay. Okay, so I'm just gonna get my pointer up. Okay, a little bit of a lag in my slides. So, well, let's talk a little bit more about momentum investing, and you understand the logic here. When we talk about momentum investing, is actually what we call trading, as simple as that. You know why? Because the logic behind momentum investing, it takes advantage of short-term volatility in the market movement. Now we start talking about volatility now, okay? So this is the part when we talk about volatility. It's not velocity, it's not momentum. The act of trading using momentum by exploiting volatility, and that's basically what momentum investing is. That's basically what trading is. Okay? I know some of you are probably from the stock market. You know, if you are from the stock market background, let me know in the comments. Let me know in the chat. This is actually going to be a very different view from a traditional investing, where a portfolio is created and formed and then held for a long term. Because we buy stocks, I'm looking for value, right? I'm looking for, you know, the company's growth. I'm looking for the company's potential. Or maybe I invest because I use Apple products. I buy Apple. I like to drink Coke every day. I buy Coke. I buy Coke stocks. Simple as that. I like McDonald's. I'll just invest in MacD because, you know why? Because I love them so much. You know, that's basically what the traditional logic of investing is. Okay. The difference compared to CFD trading, I talked about this earlier. Short selling in equity is actually more complex, and equity traders must actually look for other stocks with the appropriate momentum if they want to continue momentum investing. That's why they adjust their positions here and there. Okay, so in trading CFD, we can buy and sell according to the momentum more easily. So if you start out in the FX market, the futures market, or future commodity futures market, that's actually going to be a lot easier. And then trading from stocks, maybe there's going to be less risk in the equity market, because in terms of leverage, I don't think it's actually huge. In terms of margin trading, a lot of traditional investors actually avoid margin trading, so it's a little bit more one-to-one. Maybe there's going to be less risk, but in return, short selling in the stock market is actually not that easy. So something to take note. Okay, so when it comes to trading or momentum investing, we're going to call it trading anyway. You need to select the right instrument, so you need to know what to trade. You cannot just randomly buy stuff, or if you don't understand a correlation in the market. Again, correlation is a completely different webinar that we are going to talk more about later on in this webinar series. Okay, the risk will actually revolve around timing of the opening and closing of a trade, right? It's not a matter of direction. When we talk about investing, or we talk about swing trading or position trading, that's completely okay. I don't quite care about when I jump in, as long as I get in the right direction. But a lot of scalpers, a lot of intraday traders, they're going to find it really hard if they get the timing wrong when they jump in or get out of the market. So entry timing your entry is actually anticipating trend changes and opening that trades faster before the trade accelerate. Okay, so that's why we actually need to understand what momentum is. It's actually there to help you figure out if a trend is actually going to reverse, if a trend is actually going to continue. That's anticipating potential trend changes. It could be a continuation, it could be a reversal. So in trading CFD, you can actually buy and sell according to that momentum very easily. And then obviously we need to understand position management, which must be implemented and takes into account the potential disruption from widening spread, as well as the length of time the trade will be held. Very simple. Last week we've got US CPI numbers. Tell me, how was that for you guys if you guys were trading last week? If you didn't know that CPI numbers or you didn't know what to expect from that CPI numbers, then yeah, you probably realize that the market just suddenly knee jerks in one direction, right? That's what we call volatility. When that news is released, when people scramble to get a position or get out of a position, right? You'll experience this every month, every first Friday of a month during the NFP session, right? Your spreads could widen. That's volatility. Okay, there's going to be disruption to normal spreads. Your spreads could widen, and that could trigger your stop loss if you have a very tight stop loss. Okay, or if you jump in, you could get in with a really bad spread during the news. Okay, that's fundamental. We are going to talk about fundamental later on. Okay, so last week, for example, take a look at the chart last week. Something changed last week. Okay, the CPI numbers from the US came in a lot lower than expected. It dropped. It actually weakens the dollar. It strengthens the euro. And then this week, just last Wednesday, the FOMC meeting minutes came out. A lot of people got it wrong the first time, right? When they read the news, or if you read the news, you don't understand what's going on. My Telegram channel gets the update. They know what's going on, right? They could get the information wrong, and obviously that's going to be risk. Okay, that's volatility in the market. We're talking about unexpected risk in the market. You know, the market suddenly jerks up and down. If you don't know what's going on, a lot of traders actually wait for that volatility to happen before they jump in. But that's trading. Trading is actually exploiting volatility. But you need to understand momentum before you do that. Okay? And then when it comes to trading, obviously you need to figure out your exit points. You time your entry. But if you don't know when to get out, that's going to be a problem as well. And this is where momentum starts to come in again. Because again, momentum is looking at potential changes in trend. If you're in a long position, you have a buy position, and then the momentum starts showing signs of potential reversal, do you still want to stay long in that position? Do you still want to stay in that buy position? No. You're probably starting to look for an exit because you know there's a potential for the market to actually reverse that trend. Okay? So if you get in with something to identify momentum, you need to get out with something that identifies momentum. This is what we call consistency in charting or in trading. So we're using the same system throughout that one trade. Okay, so if you get in and the reasoning is that, hey, the momentum just turns up, we're in an uptrend, I need to go long. Simple as that. You stay in that trend until you saw signs that there's going to be a potential reversal. How do you figure that out? Maybe you look at divergence, or maybe you look at an oversold market condition, right? And that's maybe your cue to get out. Hey, maybe you know what? I'm in a profit. Maybe I need to get out a little bit. Market's going to a sideways market condition, or market is actually going to reverse. I need to get out to secure my profit. There's no point in getting a very good entry, but if you're unable to get out or time your exit as well, then what's the point, right? That's just going to go to waste. Okay, so let's talk a little bit more about trading alpha and beta before we go into sideways market condition, because you are eventually, not now, but later on as you get better in trading, if you understand what an alpha is or a beta is, that's basically your goals in trading and investing. People talk about Seek Alpha. There's actually a website called seekingalpha.com. It's a really good website if you trade equity market. When you seek alpha, you're actually looking for excess return or abnormal rate of return in the market. That's where you could exploit the market. That's where you make your profit. Okay? But you want to avoid beta. Okay? You want to avoid beta because beta is actually your systematic risk or volatility risk. Some people look for both alpha and beta. You know, they might see that, hey, you know what? The alpha is getting higher. That's going to be an abnormal market, right? And the beta is actually getting higher. There's going to be a lot of volatility in the market. There could be a potential breakout. It really depends on how you look at it. But normally, when it comes to trading, you want to seek alpha and you really want to avoid beta. Okay, and that's why we talk about portfolio diversification. It becomes necessary when you start investing and trading for the long run, because we're going to talk about diversification during risk management webinar, but it's basically trying to avoid systematic market risk that can be isolated through diversification. When we talk about systematic market risk, we talk about inherent risks in the market. You know, what goes up needs to go down. Very simple logic in physics, right? The problem is that a lot of people actually believe, and especially true if you're a technical trader, you actually believe in efficient market hypothesis to believe in price, right? Price includes all information, and this makes the price always right. You've heard about this, don't lie, okay? If you are a technical analyst, and I am a technical analyst, this is what I used to believe in. I used to believe that every fundamental data, every risk in the market has actually been priced into the market. And the reality is this logic doesn't apply, because I can explain it in one paragraph. If this efficient market hypothesis is true, then systematically there's actually going to be no risk in the market, because there's no alpha, because there's no excess return, there's no abnormal rate of return, because everything is already priced into the market. There's no surprise in the market, right? The market will then never experience an overbought or oversold market condition. You know why? Because every price movement is normal. There's not going to be an overbought oversold market condition, because that is abnormal. Okay? If you believe in price, and price is always correct, we wouldn't be here talking about momentum. We wouldn't be here talking about potential divergences or potential trend changes in the market. Because if everything is correct, if you know what that price is correct, maybe you guys have experienced this. Market goes up, you buy, and then all of a sudden, instead of being in an uptrend, it starts reversing, right? It starts doing a correction, and then it reverses, become a downtrend. If this theory is correct, then you shouldn't have any problem with price telling you, hey, you know what? I can tell you straight away, market starts correcting itself without any changes in momentum. You don't even need that. You know why? Because price is always right. But from experience, I can tell you right now, and I used to believe in this, efficient market hypothesis. I used to not look at fundamentals, and I say, you know what? Fundamentals, it's just too hard, it's more for longer term, blah, blah, blah. I just look at technicals, pure technicals, and if you go pure technicals, then you believe that everything is already priced in price, okay? Price is not always right, because the oscillators that we are going to be applying, they could show signs of divergences. Again, divergences, we're going to talk about that in future webinars. But that's basically a quick look at alpha and beta. So let's talk about overbought, oversold. Once you understand alpha and beta, right? We understand the efficient market hypothesis. Because by observing the oscillator that measures momentum, price is not always right. Because indicators such as the oscillator types, they can give you signs of divergences. Divergences, if you don't quite get it, it's basically where something starts to diverge. Something starts going in the wrong way, okay? Because the market is cyclical, as I say, it's simple physics, simple logic. What goes up must go down, and what goes down must go up, because we have a corrective wave for a correction in the market, and we have an impulsive wave. So a corrective wave could be, where a market starts trending. I didn't say specifically it's an uptrend, because we have an impulsive wave in a downtrend. Sorry, a corrective wave is a short-term correction in the market. An impulsive wave is basically the market going in the direction of the trend. Let's go back a few slides. Take a look at these slides again. The green boxes, those are your impulsive waves. These are your corrective waves. and it just becomes impulse corrective, impulse corrective, impulse corrective. What you need to identify in the market is actually when this potential impulses and corrective waves actually ends. And that's the whole point of using momentum in trading. Okay? So the characteristic is that it's actually natural for a trending market to make corrections or consolidate. Okay? The journey of a trend must have a turning point, and we can basically categorize that turning point into an overbought and an oversold market condition. Don't worry about it. You're still not clear about overbought, oversold. We're going to go through the oscillators one by one, and every single one of them has a different overbought, oversold condition that needs to be met. Okay? So, again, I'm going to show you glimpses of divergences. Most of you that followed my webinars from either last year or 2 years ago, you guys understand what divergence is. And I talk about divergences pretty much every Wednesday, right? Without fail, on every Wednesday, I'll talk about divergences in the market. Okay, but we will cover that in depth in future webinars, so don't worry about that. I'm not going to leave you hanging. We are going to talk about divergences in this webinar series, so don't worry about it. Just wait for it. Attend every week's webinar to know when that session is going to be. Okay, so let's take a look at stochastics. Very simple. Let's understand overbought and oversold. See, the stochastics goes up. The red arrow points out when the overbought actually happens. The overbought in stochastics is actually when the stochastics goes above 80 and comes back below 80. That's the overbought condition. It's not when the stochastic goes to 80 and we call that overbought, we start selling it. It's wrong. Okay, it actually needs to go up and down. So it basically needs to go above the cloud and come back down again. Very simple. Okay, there's RSI over there as well. Okay, maybe RSI doesn't show that very well in this scenario, but stochastics does that because I filtered the stochastics. I use a different settings than the standard stochastics. But the overbought condition is triggered when stochastics goes up above 80 and drops back down below 80. Okay, take a look at the drop in the market. And take a look when it starts going below 20, right in the middle there. Okay? If you think the stochastics becomes overbought when it touches 20, you're going to be in a mess, because that's when the market starts trending. Take a look at how quickly the market drops when the stochastic is actually below 20, right? And it continues to drop until an oversold condition happen. That's when the stochastics drops below 20 and moves up above 20. That's basically when the market starts picking up again. Okay, so if you thought, okay, hey, this is an overbought condition because stochastics hits 80, that's when the market actually speeds up a little bit more. You're going to be in a lot of trouble. The market's going to drag you if you start shorting it there. Okay, you don't start shorting it there until it becomes oversold. Okay, I'm going to leave it here. Hopefully you guys understand what an overbought, what an oversold is. I'm actually going to pause for a minute here. I'm going to go through the questions. But if you do have a question on overbought, oversold, hey, you know what? Type it in. Okay, let me know. But you guys feel free to screenshot this one here if you want to. Okay, so I'm going to go through the questions very quickly because I need you guys to actually take a look at this very quickly. Okay. Thanks for joining the Telegram channel. I really appreciate it. Atul, we're not going to take a look at the market today. We're actually going to take a look at more of an educational session. Is alpha trending and beta sideways? No, alpha and beta is always together. They don't identify trends, but it's actually one. As a trader, we look at both alpha and betas. It's just a lot of people think, all right, you know what, alphas and betas is actually tough, right? No. That's basically what you guys do as a trader every day. You look for abnormal rate of return in the market, but you also need to watch out for systematic risk and potential volatility risk in the market. Very simple. Okay, so great. We're in. You guys don't have any questions on overbought oversold? Don't worry about this. We'll come back to this every Wednesday, or even every Monday's outlook. Right? I'll talk about my market being overbought oversold, like the Aussie USD last week or so. Okay. Anyway, you learn this eventually once you understand what momentum is. In fact, if you understand the indicator and how it's supposed to be looked at, you'll get this easily. Okay, let's move on. So this is you can take a screenshot of this one as well, because this one highlights the wrong understanding of reading an overbought and oversold condition, which could actually cost your trading account. Take a look at the highlighted red box on the stochastics. That's how long it actually stays in below 20 on the stochastics. That, like the first question that was asked in the session, right? Stochastic goes up, the market keeps trending up. And this is the logic behind it. It drops below 20. That's actually where the market could actually start trending. If you take a look at the drop here, it takes 14 bars. It actually takes 14 hours to drop, even more than when it initially dropped from the top. Okay, that's how big it is. Okay, when it touches 80, market continues to go up and push higher. It actually goes up by another 40 pips, and it doesn't actually go down until, you know, the overbought oversold that we classified just now. That was basically the red arrow and the blue arrow. That's where your Q is to buy and sell, compared to the red boxes or the green boxes, where you might have used overbought and oversold condition in a wrong way. Take a look at this quick drop here. This is huge, right? I mean, the market drops like that. Yeah, you know what? Momentum stays there. Take a look at the whole drop. Momentum just stays below 20, and it drops significantly. It starts to create a trend continuation in the market. So you get this wrong, you're gonna mess up your trade. So 2 slides, the previous one and this one. Take a look at this very, very closely. You want the dates. There are dates below on the chart there. So take a look at the dates there. This is on the hourly time frame. You know, you can take a look at the watermark on the chart itself. You know what you're looking at. Go through the chart. If you don't believe me, go through it. I'm not cherry picking it. If I'm cherry picking stuff, I wouldn't leave the dates there. I wouldn't even leave the time there. Okay, so you got timestamps, everything, the dates. What is it? This is on the pound USD. This is on the hourly time frame. So you want to review that, feel free to go back in time. Take a look at what my 2 slides are. Okay. Okay. Done. That's trending market for you. We are going to be a little bit late here. Team Octa, we are going to extend this maybe about 15 minutes. I'm going to go through this very, very quickly. But I think there's so much to cover tonight that we are just going to extend past 1 hour. Okay, so we are going to apply this in a sideways market condition now. We have been talking about a trending market, and it's actually going to be easy if you understand that. Okay, sideways market is actually going to be a little bit more complex. You know why? Because there's actually 2 different types of sideways market condition. Number 1, markets that's contained within horizontal support and resistance. That is Euro USD daily chart from 18th of July until yesterday, 18th of August. 1 month. That's your type 1 market contained within a horizontal support and resistance. I still have the number in my head. If you want me to, it's actually between 1.0100 to 1.0250. That's the Euro USD for the past 1 month. Okay, obviously things changed yesterday, but that's type 1. That's a market that's contained within the horizontal support and resistance. You want a better look on this? Go through my weekly outlook videos on OctaFX YouTube channel. I've been talking about this for the past month. So every Monday I talk about the Euro USD still being a range bound market condition. Okay, how do I know it's still in range bound market condition? Because I understand what the momentum is and how do you actually apply it to the market. Number two, type 2 market is a market that moves like a trend, but is actually contained within a widening range, a range that actually widens up. Like, some people call it what? I don't know what other people call it. I think they call it like a reverse triangle or whatever. It just doesn't make sense. It's basically just a range that widens up, right? So reading the oscillator to measure momentum in a sideways market condition will be different from that of a trending market. Observation in sideways market condition are observations of oscillator movements and not prices. Okay, for example, number one, we know the market's continuing within horizontal support and resistance. We actually don't look at the price. We actually start looking at the changes in momentum. If you are going to be trading within a range bound market condition, right, you want to get in, buy and sell within that range, then your Q is going to be momentum. It's actually not going to be price. Okay, how far will the price movement going to be? That's going to be limited by the overbought and oversold conditions on the oscillator. The change in observation is actually important, especially in regards to type 1 sideways market condition, because that's a market without a clear trend. Type 2, there's going to be some indication of the underlying trend, so you can actually still figure out easier. Okay, that's the main differences. Okay. Feel free to screenshot it because we kind of are out of time for tonight, but let's go through this. So we have a market that's normal, right? We have an impulsive wave, corrective wave, impulsive wave, corrective wave, and then the impulsive wave starts to flatten out. It doesn't actually exceed the previous high. So that's where we can actually start drawing a range, right? So we got that range from up there to down there. This blue box, that's when the overbought and oversold doesn't exist. It is what we call a choppy market condition. Okay. Take a look at the stochastics itself. It actually starts getting choppy as well. So instead of relying on price movement, you want to trade within this market, then obviously you trade using the momentum. Simple as that. But you'll kind of understand, you're not going to be able to pick out a market that's in a sideways condition. You cannot preemptively know that it's actually a sideways market condition. You can kind of guess, but there's actually not going to be a confirmation. If it keeps bouncing up and down, if it hits a resistance level and it comes back down, hits a support level, comes back up, and it does that maybe one time, two time, then that's maybe your cue to think that, hey, you know what, maybe the market's not going in a trend, maybe it's consolidating, it's going into a sideways market condition. But you'll take a look at the momentum here on the oscillator. That's an overbought condition, but notice this, that's never an oversold condition. That's basically cue number one if you're using momentum in a sideways market condition. If the market flattens out without showing you an oversold condition, it just keeps telling you, hey, there's an overbought condition. In fact, it shows it once, twice, three times that it's overbought. But all these three cycles, it never shows an oversold market. Then that's where you know the market is actually not trending. Something is wrong. Okay, price is not going to tell you that. Price is not going to tell you, hey, I'm actually going sideways, because if you go by price, it's not creating a new low, but it's not going anywhere either. Okay, maybe create one new low, but it actually didn't go any lower than this low, right? So, yeah, it doesn't create a continuous low, right? We created a new range, a new low here. The price never actually breaks below that low. Okay, so if you go by price, you wouldn't know. Because right now you're probably going to start thinking, and this is for 75 bars. This is on the other time frame. That's 75 hours. Imagine that, opening a trade. If you're an intraday trader, 75 hours, you are stuck with one long trade that doesn't go anywhere. See if you can stand out for 3 days like that. 75 hours is not 3 days. It is 3 days? Is it 3 days? Yeah, it's more than 3 days, right? Imagine having a long position that you hold for 3 days, and normally you trade, you close your position in like 4 hours, and all of a sudden you're stuck with a trade for 3 days. How do you feel as a trader? You'll probably just give up. And then the moment you give up, it starts going up again. Okay, so you kind of need to be able to read what a sideways market is. This is actually the easy one. The next one is actually going to be the harder one. Okay, because the market goes up, right, in an uptrend, but it goes up very, very slowly. The range will just widen. It'll just create a higher high, lower low, higher high, lower low again. It just widens up the trend line there. You're not gonna get a parallel lines that goes up. It's actually gonna widen out like that. So it's gonna hit your high. If you place your stop loss at your previous high, it's gonna hit that high. If you place a stop loss at the previous low, it's also gonna hit that low. Okay. So key pointer here, number one, range widens, but the overall trend still exists. The overbought and oversold condition will exist because the underlying trend is still there. It's just really, really choppy. This is why we take a look at beta, because this is categorized as a systematic market risk. Therefore, this is what we call a volatility risk. Okay, so sideways application to this is actually going to be the same as it was a trending market. The difference here is that it will create a new high, and at the same time it will create a new low. Okay, that's where it becomes choppy. That's when you know there's a volatility risk in the market, because it doesn't go like a normal trend. Okay, simple. Okay, so that's done. We are done with how to apply momentum, blah, 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 overbought, oversold, talk a little bit about divergence, yeah? We're going to talk about the oscillator. I will cover two because we are likely going to be out of time. We're already exceeding the time allocated. But I'll cover MACD and the RSI. We will cover stochastics. If you have any questions about stochastics, jump in on my webinar on Wednesday. Ask questions there if you want to, because that's basically a live Q&A session. That's also a live market outlook session. That's a live trading session. There's also a Q&A session. So if you have any questions about tonight's webinar that didn't get answered, maybe because we're out of time, come in on Wednesday on same time. I just do that every Wednesday. Feel free to ask, okay? So we got MACD, RSI, stochastics. These are the oscillator type, the three oscillators that are mostly, oscillator types are indicators that are used to measure momentum in the market. These three oscillators are also the most used indicator. Okay, even if you don't understand momentum, you'll still use one of this in your trading career. I bet you probably plug in some MACD, try out RSI, try out stochastics, because you think, hey, stochastic crosses up, RSI goes up, market goes up with it. Oh, but I can't use it right, I get it wrong. Okay, some of you probably experimented with this. Okay, these three are the most used indicator, not by beginner traders, but also by experienced traders, because these three are what we use to identify divergences in the market. All three indicators will actually react differently to price, from MACD being the most lagging to the RSI being the fastest to react to changes in price. And there is a logic to that, because the MACD, the RSI, and the stochastics actually looks at different things in the market. Okay, so we'll go with MACD first. Okay, in fact, I think the MACD article just got posted out today on the OctaFX newsletter. So some of you probably have read it. It's actually out today. I got the notification. I wrote that article, so yeah, the content's going to be the same. But the MACD, or the moving average convergence divergence, if you don't know what an MACD is, it's actually moving average convergence divergence. It's actually classified as an oscillator. Therefore, this is a momentum indicator designed to monitor a trend. Almost similar in function to the stochastics oscillator and also the RSI, or the relative strength index. I put the word there, almost similar, but they're not similar because they're looking at different things. Okay, so the basic composition of the MACD is actually it actually consists of 3 exponential moving averages. First one is the exponential moving average 26, EMA 12, and then EMA 9. Okay, that's the signal line. The MACD itself is actually the relationship between EMA 26 and EMA 12. That's your MACD line. If you go by default on if you're using MetaTrader 4 and 5, but the default MACD will be different. It might be missing the histogram. I believe it's actually missing the histogram, or it might be, it would be missing the histogram, I believe. So the MACD line is actually 12 minus 26 EMA, right? 12 minus 26. So the difference between 12 and 26 EMA, that gives you the MACD line. So once you get the MACD value, the next observations are the MACD and the signal line. The signal line is actually EMA 9 applied onto the MACD. Okay, so it's applied on the oscillator windows. It's not on the price chart. We'll take a look at that after this. So the difference between the MACD line and the signal line, how far it's apart, that's then plotted on a graph, and that forms the histogram. Okay, so traders actually use the histogram to read an asset's bearish or bullish momentum, whether a market is trending or to the upside or downside. A lot of traders that uses MACD uses that histogram as a guideline. Okay, I use stochastics. That's my preference. Again, MACD, RSI, stochastics. You want to use all of them at the same time, feel free. But I don't recommend that. I would just say, you know, pick one, especially if you're looking for divergences. Okay, so this is basically what the MACD line is. If I plot the 12 and 26 EMA on price, the difference between 12 and 26 is actually what forms the blue line, the MACD line. As simple as that. So if you take a look at the movement of the MACD line itself, it actually looks like how price is moving. It's just filtered out. Simple, right? If it's if the MACD line is above the baseline, we call the histogram 0 as the baseline. If MACD, the blue line here, is above the signal line, the histogram is going to be positive, right? It crosses below the signal line, it becomes negative on the histogram. It crosses above the signal line, it becomes positive. Simple as that. So MACD bigger than signal, you'll get a positive baseline, you get a positive histogram. You get 0 when it actually crosses. When MACD and the signal line has the same value, it will become 0 on the histogram. If the histogram is negative, then you know that MACD is actually below the signal line. That's how we plot MACD. So MACD can be used in a lot of different ways. Number one, we can use this as a trading signal. Okay, so we got an uptrend down here. So there's a higher high, higher low. You can also draw a trend line, right? Obviously, you can draw a support trend line if it's an uptrend. So we're only looking for we're only looking for a bullish crossover signs in an uptrend. Okay, if you see the market in an uptrend, you will only look for bullish crossover signals between the MACD and the signal line. That's why it's called the signal line, right? If MACD crosses up on the signal line on in an uptrend, then go long. We are going to ignore any bearish crossover. So that's where this is starting to trend. We go long here, right? Because the MACD is above the signal line. We don't sell here because it's an uptrend. We'll only look for a buy if the MACD crosses the signal line to the upside. We don't sell where the blue box is because the market is in an uptrend. So trend is your friend. If you want to use MACD as a trade signals, do it one way and make sure the market is trending. Don't use this if the market is in a range bound market condition. Don't use this if the market is in a sideways market condition. Don't trade it like that. It just doesn't work. So this method works only in a trending market. Okay, so feel free to screenshot it, but you'll get it once you look in the chart. What do I mean by that? Okay, the main function of an MACD is actually to look for divergence in the market. I say we're going to take a look at divergence separately, but here's a quick hint. Price is not always right, because there's a bullish divergence happens in a downtrend when price creates a lower low, and the MACD lines actually creates a high low. The picture here is written in Indonesian, but I'll just translate it. Market needs to be in a downtrend for a bullish divergence to happen, and price continues to create a new low. This is where a lot of people start selling it, right? Continue to sell it, and all of a sudden, oh no, the market just reversed. How do I know there's going to be a divergence? Because the MACD starts going up. So price continues to go down, the MACD starts creating a higher low. Okay, we know something is wrong there. Okay, MACD bearish divergence. A market is in an uptrend. Market continues to create a new high. All right, price continues to create a higher high, but the MACD starts creating a lower high. Okay, so when market goes up and then the momentum tells you otherwise, maybe you should question it, because market is not always right. There's a lot of noise in the market. The MACD, or the oscillator that we use to detect divergences, actually filters it out. We use this exponential moving averages, which slows down the price. That's why we call it a lagging indicator. But lagging indicator used the right way, it can be a more of a predictive nature, because it'll tell you, hey, hang on a second, market might be going up, but the momentum starts going down. Something is wrong here. Momentum is, the trend is starting to lose momentum. Okay, that's basically the logic behind divergence. Okay, if an uptrend starts to lose momentum, then there's a potential sign of a reversal. Simple as that. If a downtrend starts losing momentum, there's a potential bounce that's likely going to happen. Okay, these are regular divergences. There's a different side of divergence, which is called hidden bullish or hidden bearish, and that's to look for a continuation in a trend. Again, we're going to talk about that later on. Okay, let's talk about MACD as being overbought or oversold. And I don't like MACD as an overbought oversold indicator because this is how we look at it, right? The overbought and oversold condition is only seen when the MACD line suddenly creates a sudden drop to the downside or a sudden spike to the upside. It'll become oversold when the MACD starts going up. When you start noticing that, you have a short period of time to figure it out. Okay? When it spikes up like that, we're only looking at the blue line. You'll know it's oversold because the market starts crossing above the signal line when price is going down and it spikes up. Okay? It becomes overbought when the market quickly spikes down. I don't like this because this is actually very hard for beginners to figure it out. And even for an experienced trader, I've been trading for 20 years, I still don't like this because it's so vague. I don't think this is what the MACD is designed for. I think it's a side effect or a side function because there's divergences in the market that, we could identify overbought and oversold condition in the market using the MACD. It's just not the favorite way. Okay, the overbought or oversold conditions identified when the 12th EMA moves very quickly away from that the 26. So if you draw the EMA on price and if there's a rapid jump up, then you'll know because the MACD line moved very quickly to the upside or to the downside. I'll be honest with you, I don't like this tool. I don't like this indicator as an overbought oversold condition. If you're a beginner and you're just starting to get used to the concept of overbought and oversold, observe that through the RSI or the stochastics. It'll just give you a much better look at an overbought oversold market. Okay, the MACD is good for divergences. The MACD is really good for entry in a continuing trend, right? Because in the trending market, there's a problem with traders. They don't know when to jump back into the trend. So you can use the MACD signal line like we just talked about in this slide. So as your trade signals, that's completely fine. You want to look for divergences, that's completely fine. But as an overbought, oversold tools, don't quite like it. I wouldn't recommend it. Simple as that. Okay, let's take a look at the weakness here. MACD as an indicator is actually quite versatile because it can provide you a lot of information using only one indicator. But nothing is perfect. And that's why the overbought, oversold side, I don't like it. And the other side that why it's not perfect, MACD is based on observing the difference between two EMA. Okay, one EMA or one moving averages is already an average of price. So having two and then measure the difference, that's double the filter. Okay, so you're averaging price 2 times and then you measure the difference and then you get the MACD. And that basically furthers the relationship between MACD and price. So if you think MACD looks like it's in the same movement as price, it does. But it doesn't reflect that. Because the MACD line is actually filtered twice. Simple as that. It's actually going to be lagging. Okay? And that's the advantage of the MACD. But it's also a weakness because it's laggy. The advantage is that by being an average of an average, it filters out market noise. Okay, but because the MACD calculation, which filters it out twice, and the observation method often gives signals or information that is lagging. Therefore, this is not a suitable indicator for traders who must be able to follow and detect price changes in real time and fast. So what I'm trying to say is, if you are a scalper, if you're trading on 1 minute time frame, 5 minute time frame, 15 minutes time frame, this is not your indicator. I think the minimum time frame for this one is actually an hour. Okay, you might be able to find success in 15 minutes, maybe, but this is not designed for short-term traders. This is actually designed for more of a longer-term potential buy signal or longer-term trade signal, longer-term divergences. Because if you apply this on a shorter time frame, it's actually going to be really, really choppy. I just don't like that, and I think it's a weakness. If you need to react really quickly, if your strategy says, I need to get out on a breakout, for example, then this is not your indicator. I think this is a weakness because it's a lagging indicator. Simple as that. Okay. Okay, moving on. Let's go RSI. RSI is also a momentum indicator. The RSI compares, this is where it starts to differ, yeah. The RSI compares an asset's strength on days when prices are rising with its strengths on days when prices are down. So the RSI is actually the average of the velocity of price going up as well as the down days. Okay. The formula is very simple, but it's actually really hard to correlate. I think we got MACD this week, either next week or 2 weeks. In next Friday or maybe the following Friday, I don't know. The next newsletter is likely going to be RSI, so you might find some details in there. Okay, there's a formula in there that I've typed out as well. I think last 2 weeks we got stochastics. This week we got MACD. So next week is RSI. Okay, so if you haven't subscribed to OctaFX newsletter, you're missing out a lot because I create those articles on, and it's a pretty lengthy article. Okay, anyway, relating the results of these comparisons to price action can give traders an idea of how an asset is performing. RSI is an oscillator, and it's actually drawn on a scale of 0 to 100. Okay, very similar to stochastics. It can be used to indicate overbought and oversold conditions in the market. So if it's starting out, then yeah. It can also be used to identify divergence for potential reversal in trend and continuation in trend. It can also differentiate a reversal from a short-term correction. We'll take a look at this, and this is actually going to be new to a lot of you guys. It can also be used to identify buy or sell signals, something I forgot to type in here. can actually tell you the direction of a trend. Okay, so RSI, it's really unique. People thought it's just, oh yes, overbought 70, oversold 30. RSI, it's not that simple. A lot of people actually, you might like RSI. I just don't like RSI because it reacts to price really quickly. That's why I prefer stochastics. But if I go through this session tonight, you might like RSI because there's a lot of RSI functions that you can actually use. Okay, so this is what RSI looks like. It will actually mimic price movement. Okay, but this is RSI. This is how the RSI looks like. Okay, overbought and oversold conditions, same logic. Like the stochastics, we need the overbought range. Sorry, the threshold limit is actually 70 and 30. Stochastics is 80 and 20. But again, you can change this. Some people like it at 60-40. There's a logic between 60-40 there. Some people like it 80-20. But the normal default setting is actually 70-30. But the logic is simple. It's just like stochastics. Hit 70 doesn't mean it says 70. But unique to the RSI, take a look at this. Market is trending down, and it'll only identify the oversold condition, right? Unlike the stochastics, where if it doesn't become oversold, it starts going sideways. The RSI doesn't do that because the RSI will tell you how to look at the trend. But the threshold limit in this example is 70-30. Okay, the same logic applies to how we look at the stochastics, but something unique with RSI because it can stay in a trend and continues to tell you the oversold condition. So how do we know it's trending? Next slide is going to give you that. It is also a trend indicator because in an uptrend or a bull market, the RSI tends to stay in the range of 40 to 90 with the 40 to 50 zone as a support. In a downtrend, like this chart here, so we know this one doesn't have to be an overbought market condition because it's a downtrend. How do we know? Because during a downtrend or a bear market, the RSI tends to stay between the 10 to 60 range. There's actually a resistance that you can actually draw in the RSI, and that's actually 60. Okay, if you know the market is starting to trend to the downside. 50 to 60 will actually start acting as a resistance. It doesn't need to be in an overbought. That's why some people use 60-40, right? Because of this logic, they might be able to apply it without even understanding what it is. But 60-40 is basically this. 40 to 90, that's an uptrend. If the RSI flattens out at 60 to 50, that's a downtrend. Okay, if it bounces below 60, you know the market is actually trending. If the RSI stays between 40 and 60. That's why I told you just now. Some people actually adjust the threshold limit to 40 and 60 because if RSI stays in 40-60, it actually tells you, hey, the market is in a sideways market condition. So this is actually something going to be something new to a lot of you guys. Okay, even for those that knows divergences. I actually haven't talked about this side of RSI a lot. But go there, experiment with it. So in an uptrend, the RSI tends to stay in the range of 40 to 90, 40-50 as zone as support. Downtrend stays between 10 to 8 to 60, 50 to 60 as a resistance. If it stays between 40 and 60, it's actually sideways. There's no trend in the market. It's actually flat. It's a range bound market condition. Okay, so this is actually going to default to the RSI 14. Some people tweak their settings, but all this is basically based on the default settings for RSI, which is RSI 14. Okay, so it'll change depending on the assets or the underlying trend as well. Okay, so this is going to be new. You might want to screenshot it. We are not going to talk about volume tonight. We barely have enough time to talk about RSI and MACD. Right, we barely have enough time talking about volatility. We only have enough time talking about momentum. Okay, next one is RSI breakouts. RSI, you can actually draw a breakout in RSI. This is applicable if you're trading the US range breakout, the UK range breakout, or if any breakout strategies in price. You will know that could be a potential breakout if the RSI actually mimics price. Okay, if you can actually draw a breakout in price, then there's potential breakout here. So price breaks support in line with RSI breakout. So you get confirmation from price, double check it with RSI, so you know that breakout is going to happen. Okay, likewise, before the trend continues from a sideways market condition, right? When I say 40-60, that's sideways, all right? 60 is resistance in the downtrend, so it follows that. Hit 60, comes back down. Find a little bit of a range there between 50 and 40, and price breaks to the downside. Breakout also continues for RSI. Okay, this is something that RSI can do. Stochastics cannot do this. The MACD might be able to do this, but it's going to be so laggy. The RSI, because it reacts to price and it actually tracks changes in price, the RSI is actually suitable for breakout strategies. So yeah, I mean, if you're used to trading breakouts, draw a support range or resistance range, not just in price, but it's actually identifiable on the RSI itself. Okay, very simple. So RSI is a bearish divergence, simple logic, very simple. Market goes up, right? Regular bearish divergence, market in an uptrend, market has to be in an uptrend. Divergence doesn't exist if market is in a sideways market condition. It has to be trending. So regular bearish divergence, market in an uptrend, price post new high, RSI posts a lower high. Again, price continues to create a new high, RSI starts going down. So there's potential for trend reversal. Okay, RSI for bullish divergence, market in a downtrend, price continues to create a lower low, RSI starts to create a higher low. Potential for trend reversal, market continues to go down, RSI starts picking up. That's when you know there's going to be a potential reversal in the market. Again, this is going to be in a separate webinar, so don't look too deeply into divergence if you don't really master momentum. So master momentum first, and then we can talk about divergence. We're not going to talk about divergence until later on, so you have a lot of time to catch up. Okay, the difference between RSI and MACD. Let's talk about this because this is asked a lot. It's seldom that I give an answer out, but the RSI is designed to show whether an asset is overbought or oversold in relation to its recent price level. Okay, RSI it's designed to show overbought, oversold in relation to price level. Okay, MACD measures the relationship between two EMAs, not price. Okay, RSI looks at price directly. The MACD doesn't look at price directly. It actually filters out twice and then look at the difference. Okay, so that's different. This is different. The RSI measures price directly. The MACD doesn't measure price directly. It measures the moving average of price. Okay, both of them measures momentum of an asset, but they measure different factors, giving them sometimes giving them contradictory indications because they don't look at the same thing. So if you think they're just the same, all oscillators are the same. Not all oscillators are the same. One tracks price directly, the other one tracks an average of price. Okay, so that's a simple explanation of the RSI and the MACD. Limitations to RSI, yeah, there's a lot of limitations. RSI compares bullish and bearish price momentum and displays the results in an oscillator placed below the price chart. Like most technical indicators, signals are most reliable when they match the long-term trend. That's why the RSI is a trending indicator, right? You don't really want to use this in a range-bound market condition. So reversal signals are actually rare and very difficult to separate from false reversals. You won't get to understand reversals until you understand what divergence is. So if you think you use RSI, you know what the reversal in the market using RSI is. No, two words: dream on. That's not going to happen, not until you understand divergence. So don't worry about it. We'll take a look at that later on in the session. Because the indicator displays momentum, it can remain overbought or oversold for a long time when the asset has significant momentum in either direction. That relates to the first question that was asked during the session. It stays up there. It doesn't want to go down. Okay, if you don't understand it right, you're going to get it wrong. RSI is most useful in oscillating markets, trading within the range, but in a trending market condition. right? Where the asset prices alternate between bullish and bearish move. So if the market is in an impulse or in a corrective wave that you can identify, that's where the RSI wins. Okay. Okay, going to very quickly. I know it's been 1.5 hours. Team Octa, give me 5 minutes. I'm gonna wrap it up. Stochastics default settings is actually floating periods for %K and 3 for %D. I changed the %D to 5. We'll talk about that on Wednesday. The main stochastic line is the %K. So if you tweak the settings, you'll get %K and %D. %K is a fast stochastics and it reflects the momentum of a price move. Okay, so we got fast stochastics, that's %K. That's the current stochastic indicator value. We got slow stochastics, that's the %D. That's the %K value with an additional moving average. By default, it's actually MA3. I use MA5. So %D is an average or a smooth out %K. We'll talk about that on Wednesday. We seriously don't have enough time for that right now. Okay. So I'll jump in very quickly. What is the difference between RSI and stochastics? RSI and stochastics are price momentum. They measure price directly. They are sometimes used together. Each has a different theory and basic methodology in how you look at it. Obviously, I just explained a little bit more on RSI, but once you understand that and you compare it to stochastics, you'll start to understand what's the difference. Okay, stochastic oscillator is actually based on the assumption that the closing price should be close in the same direction as the current trend. Okay. The RSI tracks overbought oversold levels by measuring the speed of price. It measures velocity, not volatility, velocity. That's what the RSI tracks. Okay. So in general, the RSI is actually more useful during trending markets. Stochastics are more useful in a sideways or a choppy market. You gotta alternate between the two. RSI is actually really useful in a trending market. It's just that I'm so used to using stochastics. I know how to actually apply stochastics in the trending market, and I just like it that way. But by default, the RSI is for trending markets. Stochastic is more for a range bound market or sideways market condition. So you might be able to switch it up. When you know the market is trending, you might be able to use. You might want to switch to RSI. If you detect market is going in this range bound market condition, then switch to stochastics. That's completely fine. So long as you understand both of them and you know them in and out. Okay, the only limitation to stochastics is that it can actually generate false signals a lot, because it doesn't really, it measures price, but it doesn't reflect how much price is actually going to go. Okay, back to the first question. This is when a trading signal is generated by the indicator, but the price doesn't actually follow, which can end up as a losing trade. As long as market conditions are in a high volatility state and choppy, this will happen quite often, very often, and that's kind of where the problem is, because stochastic is used in a range bound choppy market condition. So one way to help this is to take the price trend as filter, where signals are only picked up if they are in the same direction as the trend, so the same logic as the MACD. The advantage to why people use stochastic instead of MACD is that MACD is super laggy. Stochastic is less laggy, but it can actually be used in the same concept as the MACD just now. Okay. So yeah, we talk about the oversold and overbought condition. Here's another one with a little bit of an explanation. If you want to, feel free to screenshot this. But yeah, that's a wrap for tonight. I'll have a Q&A session. We might give maybe about a couple of minutes here, because we are over by 35 minutes. Any questions? Do let me know. Okay. Any questions? How often Octa have live trading? I think Octa have live trading in a lot of languages. I think English is actually going to be on Tuesday with Kayong, and then me on Wednesday. And then educational sessions on Fridays. Okay. What is the logic behind past resistance is future support? The logic is more for a correction. It doesn't necessarily have to be that. That's why we use other things like Fibonacci, because it doesn't necessarily comes back. But if it's a strong, resistance, it will likely become market will likely test it as a support, because the logic is that, hey, that was a previous resistance. If market can bounce from that, then yeah, that could be a support there. MACD settings, I don't tweak MACD settings. It's 1226 for the MACD line, and then 9 for the signal line. So in market and sideways condition, it will be better for us to use RSI to detect breakouts. As I said, it becomes a preference. Maybe I'm used to stochastics, right, Albert? You know me. you've been coming to my sessions for like 2 years. I just got so used to stochastics. I just don't use RSI, but you can experiment if you want with RSI breakouts. What time frame is best for technical analysis? Any time frame is great. It's just the question shouldn't be that. The question should be, what kind of trader do you want to be? You want to be a scalper? Then go 5 minutes, 1 minute, right? Maybe 15 minutes tops. You want to be an intraday trader? Maybe look at 15 minutes to an hour. If you want to be a swing trader, maybe look an hour to 4 hours to daily. So yeah, it's what type of trader do you want to be? What trading app is the best to forecast trade? I think forecasting trade is if you check out my Monday's weekly outlook and jump in on my webinar sessions on Wednesday. Now, I think the best outlook is actually to learn how to create your own forecast. I think that's the best way. Yeah, you can. I just don't like it. It looked messy in the chart. That's why I just don't like it. Yeah, I would say day chart is best for swing trading. 4 hours is actually not bad. It's just that daily, it's more commonly used. How can you identify market continuation and using RSI? We can use hidden divergences, but again, we are going to talk about that in a separate session. If we have a 3-hour session, that's a different story. We are actually really out of time right now. Okay. So I think we can wrap it up for tonight. Hopefully you get something out of this, right? Maybe you didn't watch this live. Maybe you stay at the end. I really appreciate it. 1.5 hours on your Friday to keep me company. But yeah, hopefully this is actually going to be great for you guys. If you find this great, then do share to people that you care or people that might need this information. Maybe that they might be using overbought, or they might be identifying overbought and oversold wrongly. Maybe this session could help them. So if you find this useful, do share it with your friends and families. And other than that, have a great weekend, guys. And I'll see you on Monday for Telegram channel, and then on Wednesday for the live market outlook sessions. Yeah. All right, guys. Have a great night. And again, thank you.